So first thing to know about price action is your basic market structure. You can see you have a swing high and now you have a swing low. So in this case, this is a bullish trend. So now you have a higher high and a higher low, higher high, higher low, higher high, higher low. And here's an example. And here's an example. Get your lower high, lower low, lower high, lower low, lower high, lower low. So the way you could use this information is to determine the trend. So as you can see here, you have your lower high and here you have your lower low. So now you have another lower high and another lower low. You have another lower high. You can expect another lower low to be made. So let's talk about ranges. So let's say you are in a bullish trend. Once price breaks structure, you can confirm your bottom. You can confirm this swing low as being a part of your range. Now, when can you confirm a high? You can confirm a high when price interacts with your swing high in this case. So, as long as price interacts with this swing, we can start confirming a range. So, even if it's a retracement deep or if it's just a touch and a bounce, either way, once price interacts with this previous swing, you can confirm this as your range. So now let's say price drop back. Now you can confirm this swing as your range. So now you have your operating range. So let's say price did not retrace deep. Let's say price got up to this point, just interact with the high and bounced off it. What would be our range now? As long as price interacted with our previous swing high, this swing high is part of our range. So just in case you're confused about ranges, let me explain this one more time. So let's say you have a swing. Once that swing high is broken, you can confirm the bottom of your range. So now you have the bottom of your range. And now when price does eventually interact with this level, once price interacts with this level, now you have the high of the range. So now this is the range you're operating in. So let's talk about the two types of structure. As you can see, price break structure comes back inside of the range. Price break structure comes back inside of the range. This is your supply and demand structure. Now look at this example. Price break structure comes right back to the high of the previous range and expands. This is your support and resistance structure. So the main difference is once price break structure, when it's a supply and demand structure, price will retrace deeper. And we'll talk about it more as we go on in this course. Supply and demand structure, price will retrace deeper before expanding. In a support and resistance structure, price would reverse right here and continue. So here's an example of supply and demand structure. As you can see, once price breaks structure, it retraces back inside of the range. Once price breaks structure right here, price retraces back inside of the range with a deep retracement. And here is an example of support and resistance. So again, this is your supply and demand structure, and this is your support and resistance. Why is this support and resistance? Because price is now retracing deep in the range. So, when looking at price from a supply and demand aspect, you want to look at price just how you would look at any other transaction. So, in this example, let's say you are in the shirt business, and for you to purchase this shirt, the fair price is $5. So, this is where your shirt is being valued. Now, let's say price drops to $2.50, $1.50. If you purchase this shirt right here, you are purchasing at a discounted rate. Now, let's say the shirt rises in price and is $7.50, $8, $9. If you purchase this shirt at this price, you're paying the premium. So the takeaway here is it's best to operate in extremes. It's best to purchase and sell the shirt at price extremes. You always want to purchase something that's in discount, which means buying low. And you always want to sell at premium, which is selling high. Buy low, sell high. So, how can we put this into price action? So, the first thing we must do is we need to locate the range. And again, the range is the bottom of your range is what broke your previous structure. And the top of your range is when price comes back inside of the previous range, which would be your high. So, now this is your operating range. So, here you have your previous range. This is your high, this is your low. Once price broke, the structure, you can mark this as your new top of the range. Why? Because this swing high is responsible for this breakup structure. As you can see, this is your previous range. This high is responsible for the break. So now this is marked as the top of your range. And once price breaks the structure and comes back and closes back inside of the range, now this is your new range low. How are we going to combine everything together? By using one tool, Fibonacci retracement. Again, the bottom quarter is your discount, be your bottom quarter, and your top quarter is your premium. Let's look at this example. Here you have a breakup structure. This was your previous range. Now price came back inside of the range. So the low responsible for this breakup structure would be your new low, and this would be your high because price came back into its previous range. And this is where you pull your Fibonacci. This is your premium level, and this is your discount level. And what are you waiting for? If you can see that a bullish trend is starting, you're looking for a retracement in your discount. Why discount? Because buy low, sell high. So you would be purchasing price after this retracement in your discounted level, and you would be selling off in your premium. So we're going to use premium and discount levels when trading a supply and demand structure. So let's say this is a bullish trend. You would see your P1 proving that price is in a supply and demand structure. And price forms that new range, which was previously this. Now it's this high and this low. You pull out your fib to mark your levels. This is the settings of the fib. Obviously 0, 25, 5, 75, 1. And you would wait for a retracement down to your discount. If you want to learn more about this, make sure you enroll in ETM Concepts and use code PRICEPRO for 20% off. So let's take a look at this example. So previously you had this low and this high. So now that price broke structure and came back, this was your low. And once this structure was broken, this is your high. So what are we waiting for? We're waiting for a close back inside of the range so we can pull out our fib and mark up our premium and discount levels. Now the price closed back in the range. We can confirm that this is the low of the range. Now we pull out our fib. And you're waiting for price to retrace to this level. And this is where you would be looking for a sell. So you sold in premium. So let's talk about the relationship between time frames. So you have a swing low and a swing high on your macro, which is your higher time frame. On a lower time frame, which we refer to as your micro, this is how the swing looks. The same swing on the left side is the exact same swing on the right side, just on a lower time frame. So let's take a look at this swing. So on a macro, all we see is a swing low and a swing high and a retracement back. So once we go on our micro, we'll see consecutive swings. Now, what you would expect is basic swing high, swing low, swing high, swing low, swing high, swing low. But the reality of the market is completely different. The market would more than likely move like this. And this leads us to our next topic, liquidity. So we have a whole lesson on liquidity, so I'm not going to waste a lot of time. But for a quick explanation, what liquidity is somewhere where orders are resting and a fake out for traders. So here you are in a downtrend. And as you can see this swing, remember, we are in a downtrend. So there should be no reason for price to break structure. Price will come up. What would retail traders do? They would try get into a buy position, thinking that price is changing character, just for price to reverse and continue the downtrend. So let's take a look at this example. Can you locate all your supply and demand opportunities and your liquidity trap opportunities? What about now? So to make this easier, let's remove price action completely. What do you have here? Price breaking structure coming back inside of the range. Price breaking structure taking out liquidity. Price breaking structure taking out liquidity, trapping sellers. Price expands, goes in a supply and demand structure. Price reacts of your demand. Price changes character and goes off your demand again. Retraces back inside of the range, which would still be considered a supply and demand structure, but never reaches the extreme demand. Comes back, reacts again of your supply. Here you have a liquidity grab. Price grabs liquidity and drops down. And here you have another supply entry. Take a look at this example. Price made a high, came back, made another high, made another higher low, and made another high. So up to this point, you would think that the trend is bullish. You can confirm the trend being bullish. What does price do? Price comes down instead of making another higher low. Price comes down and makes a lower low. What is the purpose of this lower low? This is the trap to trap out all the sellers. This would be your liquidity grab, trapping all the sellers before continuing the bullish trend. So let's talk about reversal points. Price picks a direction, consolidates, and changes direction. So when it comes to your reversal points, there's two major profiles. As you can see, you have a break of structure. Price comes back inside of that range and expands again. Now, what happens next is price drops down to the previous swing and reacts of the demand zone. So the second profile would be price breaking structure, coming back inside of the range, now expanding again. Now, when price does come back inside the new range, price takes out the sellers, goes for a liquidity grab, just to reverse and continue with the intended trend. So take a look at this example. Price had a direction, but went into an accumulation to change direction. Just how we explained previously. Now, what happened here? Price broke structure to the downside and started a micro bullish trend. So after you have your main peak, which will be your main purge, what happened here? Price expanded, retraced, and went for the stops. Price took out the stops, grabbed the sellers, and changed direction. Hope you guys enjoyed this lesson. Please make sure you like, share, and subscribe. And let me know in the comments if you guys want a part two. Make sure you comment part two.